Hello and welcome to the first short video talking about accrual accounting and chapter 4. So this is a really tricky chapter because it really involves everything we've learned so far and then builds on it a little bit more. So when it comes to tricky concepts, I like to have an example in mind. So I want to pretend that we are opening a dog grooming business. And so if I was wondering if this company is profitable, what financial statement I should look at. Hopefully you said the income statement. So if I want to know about my company's profitability, I'll go to the income statement. Now, if we think about the income statement, we're going to see revenues. So revenues, what the heck is a revenue? According to the revenue recognition principle, it's the work we have done. So it signifies the work that we have done and what we've been able to charge our customers for that work. So when we groom a dog, then we earn a revenue. If the dog doesn't go in the bathtub, no revenue. So it all hinges on us, scrubbing up a dog. Now, the other thing we're going to see on the income statement is expenses. So now expenses are things you've used up while earning those revenues. So, if we use something while scrubbing up the dog, then we need to put it in an expense. How much of whatever did we use? And it goes into an expense account. So we've got the revenue recognition principle. Whenever we wash a dog, we're going to recognize the revenue. And that's the trigger for a revenue is actually physically doing the work for the customer. And then expense recognition principle, when we use up something like shampoo or utilities to run the bathtub or employees' time, then that's when we recognize the expense. So our our expenses follow our revenues. And that is according to GAAP principles. Now, the other really important principle in this chapter is called the periodicity principle or the time period principle. And it says, okay, for your income statement, we're always going to look at that accounting information in terms of chunks of time. So if we're thinking about our revenues and expenses, it's what revenues or expenses did we earn in the month of January? If we're looking at a quarter or a 3-month period, we're looking back over those 3 months, looking at all the revenues we've earned and all the expenses we've incurred. Or the biggest time period we always look at in accounting is for an entire year. So, what happened over that 12-month period in terms of revenues and what expenses happened during those 12 months. So watch out in this chapter because every question you'll do will look at a different time period. So you really need to be aware if we're just trying to capture information for a month or if we're trying to capture information for an entire year. Now, here's an example why these accrual accounting principles are so important and what they're trying to achieve. So we've got a super simple business here, Fresh Color Paints, and let's assume that this company paints a large building in 2022. It incurs and pays total expenses like salaries and paint costs of $50,000. So they're painting away in 2022, they pay for wages, they pay for paint, And then they give the customer an $80,000 bill, but we don't actually receive payment until 2023. And that's when this owner here is going vacationing in Costa Rica. Now, let's think about how much we made on this job. So if we think about the revenues and the expenses, we made $30,000 on the job. That's the important piece of information. How much are we making on the job? Now let's think about when the company did the work. So the company did the work in 2022. And that's when they earned the money. They didn't collect the cash, but they've earned it in 2022. And we want to look at this faithful representation principle also, where we want to faithfully represent what's going on in the company with our company's financial statements. So if we use accrual accounting, we'll recognize our revenues in 2022 when we actually did the work, our expenses in 2022 when we use them to do the work, so we can see, okay, yeah, we did make a profit on this job. And then it faithfully represents what's going on in 2023, because the owner's in Costa Rica doing nothing, and so is the business. Now, if we use the cash basis of accounting, it would look like we have a terrible year in 2022 when we're actually really busy, and then a fantastic year in 2023, which is ridiculous because the business isn't doing anything. And if you think about it, we have a statement of cash flows for our business that's going to show exactly this. So why would I want to show the same thing on my income statement? It makes no sense. So definitely, we need to use accrual accounting principles. And this is a super, super easy business. When you have a more complex business, it's even more important to match your revenues to your expenses to see if you're profitable or not. All right, so when we do these adjusting entries, you have to keep something in mind. We're always going to impact two accounts. So the rules of debit and credit say at least two accounts, could be more. When you're doing adjusting entries, it's only going to be two accounts. And one of those accounts is going to impact the income statement. So it will be a revenue or an expense. And, our revenues need to reflect the work done. Expenses reflect what's been used up while earning the revenue. So it will be one or the other. So, if we're looking at doing adjusting entries for the month of February, we're going to look back over this month, make sure that we've captured all the revenues that we've actually earned, and that all of our expenses reflect what we've used earning those revenues. Now, one account's going to be a balance sheet account, so that's either going to be an asset account or a liability account. So the point of adjusting accounts is to make sure that our assets actually reflect what we have. So a lot of these entries, they're really about fixing our accounts to do what the accounts are supposed to do. Our liabilities, if we show liabilities on our balance sheet, they need to reflect what we owe. If we owe something, it needs to show up in a liability account. And that's going to be at the ending day of our reporting period. All right, so there are 4 rules of adjusting entries. First of all, they're always done at the end of an accounting period. We're just fixing our accounts at either the end of the month, the end of the quarter, or the end of the year, getting ready to make perfect financial statements. They will always involve one income statement account and one balance sheet account. unlike chapter 2 and chapter 3, the transaction or the journal entry will never impact cash. So if you're doing an adjusting entry and you're not sure what accounts are being impacted, don't guess cash, because it won't be it. They never impact cash when we're doing adjusting entries. And they're always done due to the passage of time. Something happened that we just haven't recorded yet. All right, so that's the end of this video. Please check out the next one.